Let us sit down and look at some numbers that are quietly reshaping the global financial landscape tonight. The bond market is currently experiencing a structural shift that has not been seen since the great financial crisis. The yield on the United States 30-year Treasury bond has officially broken past the 5% threshold. Now, you know me, I do not care for sensationalism, and I completely refuse the industry of financial fear. But when the foundation of global asset pricing moves this significantly, we owe it to our capital to look at the math. I remember when I first started tracking macro data in my early 20s, I used to think the game was about finding the next hot asset. I thought I was an absolute genius for catching a short-term rally, which was really just an illusion before the market taught me about real risk. The truth is much more boring. It is simply about understanding historical patterns and staying completely unemotional when the crowd panics. Let us understand exactly what a treasury bond yield represents without the complex jargon that institutional managers love to use. Whenever the government needs to fund its massive annual deficit, it issues debt securities to public and institutional investors. A treasury bond is essentially a personal loan to the government which promises to pay a fixed interest rate over a set period of time. For nearly 15 years, our entire economic ecosystem was built on the absolute certainty of cheap capital. Mortgage rates were low because borrowing was heavily subsidized, and equity prices marched upward because capital had nowhere else to go. But when you can earn a guaranteed 5% return from the safest borrower in the world, the mathematical equation changes. Every asset class in the world, from equities to real estate, must now justify its risk premium against that risk-free rate. The reason bond yields are spiking right now is not because of a sudden market malfunction, but because investors are selling government debt. When investors sell bonds, the price of those bonds falls, which mechanically pushes the yield higher to attract new buyers. This selling pressure is a direct reaction to structural economic indicators that we need to examine calmly together. First, consumer price inflation recently reported a year-over-year increase of 3.8%, which remains incredibly sticky. More importantly, producer price inflation, which measures the wholesale cost businesses pay before passing them to consumers, rose by 6% when manufacturing and supply chain costs remain elevated. Corporations eventually compress their profit margins or raise retail prices. Second, global energy pressures have driven oil prices significantly higher, flowing directly into transportation, shipping, and food production. Third, the domestic fiscal deficit is expanding by roughly $2 trillion annually, requiring an unprecedented volume of new debt issuance. When the supply of government bonds increases dramatically while foreign central banks reduce their purchasing, yields must rise to attract buyers. Historically, whenever the 30-year yield approached 5% over the past 2 decades, it acted as a temporary ceiling. Investors would step in, purchase the bonds, and yields would glide back down toward lower levels as demand stabilized. The core concern among institutional risk managers today is that 5% is no longer behaving as a temporary ceiling, but rather as a structural floor. If 5% becomes the new baseline for global capital, it creates a slow constriction across 4 primary areas of the economy. First, it impacts the federal budget through an accelerating debt servicing cycle. The government currently spends over $1 trillion annually just on net interest payments for the national debt. Every incremental increase in bond yields adds billions to that interest burden, widening the deficit and requiring further debt issuance. Second, it compresses equity valuations, particularly within high-growth sectors like technology and semiconductors. When future corporate earnings are discounted back to the present day using a higher interest rate, their current mathematical value decreases. Third, the residential real estate market experiences an extended structural freeze. Homeowners who secured long-term mortgages at 3% are financially disincentivized from selling and relocating to a 6% rate. This dynamic restricts housing inventory, keeps nominal prices sticky, and reduces overall capital mobility. Fourth, corporate borrowing costs rise, forcing businesses to delay capital expenditures, moderate hiring, and protect current cash reserves. This does not mean the financial system breaks in a spectacular crash tomorrow morning. It means the economy faces a slow, regulatory grind where the probability of a recession quietly increases with every basis point change. So, how do we look at this situation as a generation trying to build durable wealth? When I managed to accumulate my first $100,000, it was not through speculative options trading or chasing momentum. It was through a completely unglamorous process of maximizing my savings rate, avoiding lifestyle inflation, and trusting the math of compounding. If you are waiting for a central bank rate cut to bail out a poor investment or to justify a speculative asset, you are playing a losing game in a world where free money is officially dead. The market naturally shifts away from rewarding financial engineering. It returns to a framework that rewards fundamental productivity, clean balance sheets, and positive free cash flow. When the risk-free rate remains elevated, every business must prove it can generate actual profits without relying on cheap debt refinancing. I used to look at aggressive market rallies and feel a massive sense of missing out, thinking I needed to take bigger risks to keep up. But after calculating the mathematical reality of a major capital loss, my entire approach to risk management shifted permanently. If you permit your portfolio to drop 50% because you chased a high leverage narrative, you require a full 100% return just to get back to zero. When you understand that simple geometric reality, you stop looking for overnight multi-baggers. You start looking for boring, consistent defensive compounders that allow you to ignore the daily market fluctuations entirely. Let us look at our personal capital allocation through the cold lens of opportunity cost under this new Federal Reserve leadership. When interest rates were near zero, holding cash felt like an absolute penalty because inflation was quietly eroding your base. Today, utilizing short-term treasury instruments or high-yield cash accounts allows you to capture a clean return while maintaining maximum flexibility. This liquidity provides you with an option value, meaning you have the dry powder ready to deploy when a premier asset experiences a forced liquidation. You do not have to force an unstable trade today because your capital is actively working for you while you wait for real valuation alignment. This approach requires a massive amount of internal discipline because the media will constantly tell you that you are being left behind. But the numbers do not possess emotions, and the long-term historical data always favors the investor who prioritizes capital preservation. We must also take a highly critical look at how we manage our personal liabilities during this structural transition. If you are carrying any form of variable debt, such as consumer credit cards or short-term lines of credit, that interest expense is compounding against you. Paying off a liability that carries an elevated interest rate provides an absolute risk-free return equal to that exact rate before we even begin to think about maximizing our equity returns. We must ensure our personal balance sheet is completely free of structural leaks. I used to assume that carrying a minor amount of leverage was fine as long as my equity investments were moving higher, but that was a dangerous assumption built on the illusion of a perpetual bull market, and a mature risk framework removes that vulnerability entirely. Let us keep a close eye on the macro calendar for the 16th of June and the 17th of June, which will mark the first official policy meeting chaired by Kevin Warsh. During this meeting, the central bank will release its updated summary of economic projections and its interest rate dot plot. This data will reveal exactly how many committee members believe that interest rates must stay higher for longer to combat the 2026 inflation reality. We should observe these announcements not as a signal to trade actively, but as a laboratory to watch how institutional capital reallocates itself. The more you observe these macro cycles without emotional attachment, the more you realize the short-term market is simply a massive voting machine. Over the long horizon, however, it functions strictly as a weighing machine, measuring real economic utility and actual underlying cash flows. Our objective is to ensure our capital is positioned entirely on the side of the weighing machine, anchored by logic and mathematical necessity. Let us audit our current asset allocation tonight to make sure it aligns perfectly with our true personal holding timeline. If you have capital that you will need to utilize for a significant life event over the next 24 months, that capital has no business being exposed to index volatility with short-term yields offering an authentic return. That capital can sit safely in risk-free instruments, preserving your upcoming plans. Only capital with a timeline stretching well beyond 5 to 10 years should be navigating the price fluctuations of the equity markets. By segmenting your wealth according to clear time horizons, you remove the immediate psychological pressure of daily price charts. You can watch a red screen without experiencing a racing heartbeat because you know your immediate stability is fully collateralized. This is the ultimate secret to remaining calm. When the surrounding media enters a state of perpetual panic, I want to encourage you to take an hour this weekend to write down your personal investment policy statement, define your exact target asset allocation, specify your maximum leverage limits, and outline your rules for compounding during expansionary phases. Having a written framework prevents you from making impulsive choices in the middle of a market correction. It acts as your personal anchor when the financial waves become choppy and the noise becomes entirely deafening. The optimal time to prepare for a storm is always when the sun is shining and the parameters of the environment are relatively stable. Once the downpour begins, the human brain enters a state of emotional survival, making logical decisions mathematically impossible. Let us use this quiet period to build our knowledge base. Refine our target watch lists and trust the compounding nature of patience. Take excellent care of your capital, protect your compounding timeline, and I will speak with you very soon. Consider the cycle of gold and silver for a moment, as these assets often act as an insurance policy against the devaluation of pure currency. We are seeing a short-term correction in precious metals, which feels painful to the people who entered the market strictly for momentum. But when you zoom out to a 3 to 5 year chart, you realize that these pullbacks are merely the breathing patterns of a larger secular trend. If you believe in the long-term necessity of a store of value outside of a government balance sheet, then short-term price volatility is your best friend. It allows you to accumulate positions at lower cost bases, which significantly improves your long-term internal rate of return. I look at the historical data of the Great Depression, and I see cycles of panic that look remarkably similar to what we are witnessing in our current headlines. The winners in those cycles were not the people who tried to predict every daily fluctuation, but the people who stayed solvent and waited for the reversion to the mean. You have to ask yourself if you are an investor or if you are simply a spectator of someone else's financial drama. If you are an investor, you have the patience to let your thesis play out over years, not days. You have the discipline to hold your assets when the market is red because you understand that price is what you pay and value is what you get. This distinction is the only thing that separates the people who build multi-generational wealth from the people who lose everything in a market correction. Let us talk about the role of precious metals in your portfolio during this specific inflationary regime. Gold has historically functioned as a hedge against the loss of confidence in central bank policy. Silver tends to have higher industrial utility, which means it fluctuates more violently based on manufacturing demand and supply chain constraints. If you are going to allocate capital into these assets, do so with a clear understanding of your specific holding purpose. Are you buying for industrial exposure, or are you buying for the preservation of purchasing power against the eventual currency reset? Answering this question honestly will prevent you from panic selling when the prices inevitably dip. I am currently keeping my eyes on specific price levels for accumulation based on historical support and resistance patterns that have held for decades. When the market hits those levels, I do not need to check the news. I do not need to listen to the analysts. I simply execute the plan that I wrote when the market was quiet. This is how you remove the stress from your financial life, by removing the need for real-time decision-making. Everything is pre-planned, everything is rule-based, and everything is anchored in the mathematical reality of long-term compounding. We are currently living through a historical pivot point, but that does not mean we have to abandon our principles. Stay grounded in your research, keep your expenses low, and maintain your liquidity. These are the only tools that actually matter when the storm starts to gather. Remember that the market will provide endless opportunities to generate wealth, but it will only provide a limited number of opportunities to lose everything. Your primary objective is not to be the smartest person in the room. It is to be the person who is still standing when the room eventually clears. Continue your reading, continue your research, and always maintain a healthy skepticism of anyone who promises you a shortcut to financial freedom. There is no shortcut, there is only the path. And it is a path that requires the quietest kind of courage. Take excellent care of your capital, stay incredibly disciplined with your process, and I will talk to you very soon.